History shows us that in every major economic collapse, there is a recurring pattern of what survives and what vanishes. While most people worry about their portfolios dropping by 20 or 30%, a true systemic crash targets specific assets that don't just dip, they go to zero. These are the assets that rely entirely on the stability of the system to exist. When that system fractures, the value tied to these assets evaporates overnight, leaving investors holding nothing but digital dust or worthless paper. Understanding these 5 categories is the difference between weathering a storm and losing everything you've worked for. The first asset that loses all value is speculative growth stocks with no intrinsic earnings. In a bull market, investors buy into potential and future disruption. Companies that lose money every month are valued at billions because credit is cheap and optimism is high. But an economic crash is a brutal return to reality. When the flow of easy credit stops, these companies cannot fund their operations. They don't just see a stock price drop, they face immediate bankruptcy. During the 2000 dot-com bubble and the 2008 financial crisis, thousands of companies that were the next big thing simply ceased to exist. If a company requires a constant infusion of new debt just to keep the lights on, its value in a crash is zero. Shareholders are at the bottom of the priority list during a liquidation, meaning by the time the creditors are paid, there is nothing left for you. The second asset is unsecured private debt and P2P lending platforms. In recent years, millions of people have moved their money into private lending, chasing higher yields than what a bank offers. You might be lending to individuals for personal loans or to small businesses for expansion. In a healthy economy, the default rates are low and the checks arrive on time. However, in a systemic crash, the unsecured part of that debt becomes a terminal flaw. When the general public loses their jobs and businesses lose their customers, the first thing they stop paying is unsecured debt. Unlike a mortgage where the bank can take the house or a car loan where they can repo the vehicle, unsecured debt has no collateral. In a deep crisis, these loan portfolios collapse entirely, and the platforms managing them often vanish, taking your principal with them. The third asset is high-risk derivative products and leveraged ETFs. These are financial instruments designed for short-term trading, often built on layers of complex math and borrowed money. Leveraged ETFs, for example, use derivatives to double or triple the daily move of an index. While they are great for a quick trade, they are mathematically designed to decay over time. In a violent market crash, the volatility becomes so extreme that these products can gap down to zero in a single trading session. This isn't just a theoretical risk, it has happened repeatedly in VIX-related products and specialized sector funds. If the underlying asset moves too far against the leverage, the fund is forced to liquidate at the bottom. You wake up to find your investment has been closed for value, which is a polite way of saying your money is gone. The fourth asset is luxury collectibles with no utility. This includes high-end fashion, certain types of modern art, and niche hype items like sneakers or digital collectibles like NFTs. The value of these assets is driven entirely by surplus wealth. People buy them when they have extra cash and feel confident about the future. In an economic crash, that surplus wealth disappears. When people are struggling to pay for food, energy, and shelter, nobody is looking to buy a limited edition watch or a piece of abstract art for a premium. The market for these items doesn't just slow down, it evaporates. Because these items have no floor value, you can't eat them, you can't use them to produce energy, and they don't generate rent, their price in a panic can fall to whatever the most desperate seller is willing to take, which is often near zero. The fifth and perhaps most controversial asset is phantom real estate, specifically undeveloped land in non-essential locations or speculative vacation rentals. Many people believe real estate always holds value because it is physical. While a home in a productive city will always have some worth, speculative land in the middle of nowhere is a different story. These are often paper assets disguised as property. In a crash, the cost of holding that land, taxes, insurance, and maintenance remains, while the pool of buyers vanishes. If you cannot farm the land, live on it, or rent it out for a profit, it becomes a liability rather than an asset. In a prolonged depression, property that produces no income and has no immediate utility often becomes unmarketable, meaning you couldn't give it away if you tried. The common thread among all five of these assets is a reliance on a functioning, high-liquidity financial system. When that system breaks, value flows toward things that are tangible, productive, and essential. Wealth preservation isn't just about what you buy, it's about identifying what can disappear. By recognizing the fragility of speculative stocks, unsecured debt, leveraged products, non-utility collectibles, and unproductive land, you can position yourself to hold the assets that actually survive the reset. In the end, the goal isn't just to grow your wealth in the good times, but to ensure that your wealth is still there when the world changes.